Hello, dear students. Today we are going to discuss dividend irrelevance model. So it is advocated by Modigliani and Miller. It is popularly also called as um, Miller MM approach, okay, or Modigliani Miller model. Now here, Modigliani and Miller they have used arbitrage process to explain this dividend irrelevance model. So what happens usually whenever a firm declares a dividend, the potential investors or investors will demand such company shares. Whenever a firms declare dividends, okay, in that situation, the potential shareholders or the investors in the market they demand uh, such company shares, and ultimately this demand leads to increase in market price of such shares or such company shares. Now, according to dividend irrelevance model, whenever firm issues cash dividend, of course, as a result, share price will go up in the market. But on the other hand, firm may have to issue shares in order to meet its financial requirements. That means it is foregoing its profit, whatever for profit a firm earns, that will be distributed as dividend to the shareholders. Of course, as a result, in the market, the demand for that particular company share will increase, and that ultimately leads to increase in market price of the shares. But on the other hand, as the firm has distributed whatever profit earned to its shareholders, existing shareholders in the form of dividend, now for the further expansion of the business or maybe for the further investments, firm may have to or firm may depend upon external source of finance, and so the firm may issue shares in order to meet its financial requirements, and this ultimately bring down share price in the market to the previous level. So this is about the arbitrage process. So the bottom line is this. So in the dividend irrelevance model, now under dividend irrelevance approach or our dividend irrelevance model, the bottom line is this. Uh, so whatever amount of dividend, so it may be issued by the company, that will not be having any impact over the market prices. That means there is no impact of dividend over the market price of the company. So this is about the dividend irrelevance approach, and why this is the reason I have already said. It is because of arbitrage. That means whenever firm issues dividend, of course its market price will go up in the market because of higher demand. But on the other hand, as the firm distributes its earnings to the shareholders as dividend, it may require funds for its expansion or maybe for its business purpose. In that situation, it may require issue of shares, okay, in order to mobilize funds, and that ultimately uh, reduces the market price in the market to the previous level. So this is about it. Now here the dividend irrelevance approach, it makes certain assumptions. There are four assumptions, okay. First assumption is that existence of a perfect capital market. Now here perfect capital market means here the investors are rational. That means they wisely think, and they invest money or they invest in shares, okay, and they are not emotional and sentimental. They are not abided by the emotional or sentimental things, okay. They are rationally think before investing in shares. And second thing, Or second feature of perfect capital market is price sensitive information is available to all the investors. That means the information which leads to price movement, maybe upwards or maybe downwards, so that is easily available to all the investors. And the third feature of perfect capital market is securities are infinitely divisible. Okay. And the fourth one is no single investor is capable to influence the share price. That means uh, one cannot modify or one cannot influence over the market price of the share. So these are all the features of perfect capital market. And this theory or this model assumes that there is existence of perfect capital markets. And the second assumption is non-existence of taxes. Now the presence of taxes could uh, work in an adverse way, maybe in the case of capital gains. Okay, whenever shares are sold in the market, so long term investment, in such situation capital gain arises. And the tax on capital gains, so that will have an adverse impact. And again taxes on dividend also. Okay, that will have adverse impact. So here this theory assumes, or this model assumes, that non-existence of taxes, maybe on capital gains or maybe on dividends, so there is absence of um, taxes. Then the third assumption is that the constant investment policy. So here this assumption specially made to maintain um, discrete risk. That means uh, constant, because of the constant investment policy, the risk profile, so that will remain same, so it is fixed. Okay, risk will be fixed over the years. So here this theory assumes that there is constant investment policy. And the fourth assumption is forecasting ability. Every investor is able to forecast future earnings, maybe with respect of dividends or maybe with respect of share prices of a firm. Okay, so these are all assumption of the Miller and Modigliani irrelevance approach. Now let us proceed towards the problems. Now here the computation of market share price can be made with this formula. P1 is equal to P0. Here P1 means price at the end. Okay, P0 means price at the beginning. And 1 plus KE means, so KE means cost of equity, and D means dividend per share. So this is about the formula. So now first problem is like this. Tripura Engineering Limited had 1000 equity shares of rupees 100 each during a financial year. Its cost of equity was 20%. Using Miller Modigliani model, decide what will be the price of the share if no dividend is declared. If a dividend of rupees 10 per share is declared, what will be the share price? Okay. Now here in two situations we have to work out this problem. So they have asked us to calculate the market price when dividend is declared, and they have asked us to calculate market price whenever the dividend is not declared. Now first we'll consider when no dividend is declared. Now formula, P1 is equal to P0 into 1 plus KE minus D. Now P1 is price at the end, P0 price at the beginning, cost of KE means cost of equity, D means dividend per share. Now here, first, if no dividend is declared, let us identify one by one all the information. What thing we need? P1 that we have to calculate. P0 means price at the beginning. Okay, now price at the beginning is 100. See here, Tripura Engineering Limited had 1000 equity shares. 1000 equity shares nothing but number of equity shares. Rupees 100 each they have given, so that means at beginning value 100 rupees. Okay, P0 is 100. Now cost of equity that they have given during a financial year, its cost of equity was 20%, so K means 0.20. Now D1 is 0 because dividend is not declared, if no dividend is declared. So let us calculate price at the end is equal to 100 into 1 plus 0.20 minus 0. So that comes to rupees 120. Now when the dividend is not declared, the market price of the share is rupees 120 according to model. Now if a dividend of rupees 10 per share is declared, okay, now again P0 will remain same 100, KE will be same 20%, but D stands for the dividend, okay, the amount of dividend that is 10 rupees per share, so D is 10. Now if we do the calculation, so we'll be getting 110. So that means when the dividend is declared according to approach, the market price will decrease. But the declaration of dividend won't affect on the wealth of the shareholder, because anyhow he is getting rupees 10 as dividend per share, okay, and the market value is 110. 110 plus 10 means that will become 120 rupees only, okay. He can keep that he can keep that 10 rupees as dividend with himself, and he can sell that particular share, okay, in the market for rupees 110, and he will get, suppose we assume, let us assume that he'll get rupees 110 in return, so 110 plus 10, so that would become 120. That means the wealth will be remain same, so there is no changes in wealth but only changes in market value of share. So this is especially when the dividend is declared. Now let us move towards another problem. Unique Pharma Limited had 1 lakh outstanding equity shares of rupees 10 each on January 1st, 2007. The company now intends to pay rupees 2 per share for the current year. It belongs to a risk class whose appropriate capitalization rate is 15%. Determine the price of the company share using Modigliani-Miller model when dividend is declared and when no dividend is declared. Now again P1 stands for the market value of share at the end, P0 means the beginning market value, Ku means cost of equity, D1 means dividend. So in the first case when dividend is declared, and in the second case when dividend is not declared. So under two cases we have to work out this problem. Now first let us consider first case when dividend is declared. Now the rate of dividend is given, that is rupees 2 per share, right? The company now intends to pay rupees 2 per share for the current year, so that means the rate of dividend is 2 per share, and the P0 means the beginning value of share, that is rupees 10. Cost of equity is given in the problem 15%, that means 0.15. So all the information here we have, so simply we have to put all the information to the formula. So 10 into 1.15 minus 2, so that becomes rupees 11.15 minus 2. So the market value of share when the dividend is declared is 9 rupees 15 paisa. Now with the same particulars, let us calculate when, on the assumption when there is no dividend. So P0 10, cost of equity remains same 0.15, but D1 will be 0 because there is no dividend declared. So that amounts to rupees 11.15. Now here it is clear that when there is no dividend, the market price of the share will be highest. When we compare it with the price of share when there is dividend. Now let us move towards another problem. The problem is like this. Two chemical companies, Asian Paints Limited and Berger Paints Limited, had equity shares priced at rupees 150 each. During the financial year 2005-6, each one made a net profit of rupees 210 crores. Cost of equity is the same for both the companies at 10%. Asian Paints Limited decided to declare a dividend at rupees 8 per share and Berger Paints Limited decided not to declare any dividend. Using Miller and Modigliani hypothesis, calculate the share price of Asian Paints Limited after dividend declaration. Calculate the share price of Berger Paints after the results. Is there any difference in the total shareholder wealth between the two companies? Okay, that's a very good problem which is having a practical relevance. Okay, anyhow, let us calculate. Problem is simple. Problem is very simple, but just we have to interpret and we have to find out or we have to identify the things that are needed to solve the problem. That's it. Okay. First, before solving the problem, what all we need is just to have a formula. So formula is this: P1 is equal to P0 into 1 plus KE minus D. And what here problem says that Asian Paint is declaring dividend, okay, and Berger Paints is not declaring any dividend. So Asian Paints is giving away its profit, but Berger Paints is not declaring any dividend. Now, what we have to do is we have to just apply this formula to the given particulars and we have to identify the market price of the shares and then uh, we have to identify the difference between the market price of the shares between two companies and we have to write a conclusion. That's it. Okay. Now first we'll proceed with the Asian Paints Limited. Formula is P1 is equal to P0 into 1 plus KE minus D. Fine. Now here P0 is the beginning value. Now in the problem it is given that two chemical companies will be having identical share price. That means same share price, that is 150 rupees each. In the first line itself they have given. So P0 means 150 rupees. Now cost of equity. What is the cost of equity? Again, in the problem it is given that cost of equity is the same for both the companies at 10%. So both the companies will have identical cost of equity, identical rate of cost of equity. That means 10% only. Now, what is the D? Now here for Berger Paints, D stands for, as you know, it's a rate of dividend. So 0 for Berger, 0 because they are not declaring any dividend. But for Asian Paints, it is rupees 8. Now for the Asian Paints, let us put all the information. 150 into 1 plus 0.1 minus 8, that comes to rupees 157. Now for Berger Paints, let us calculate. 150 into 1 plus 0.1 minus 0, that's will get rupees 165. So in comparison, we can conclude that Berger Paints market price would be high when we compare it to the Asian Paints Limited's market price. Okay, and the reason is that there is no relevance of dividend on the market price according to because of arbitrage process. Okay, now we are supposed to know about the wealth. Okay, whether the shareholders of Asian Paints they gain better or the Berger Paints they gain better, that we have to calculate. Now here in the case of C question, so there is no difference in the total shareholders wealth in either cases. For Asian Paints Limited, so share price is rupees 157 and the shareholder receives a cash dividend of rupees 8. So that makes 165 only. 157 plus 8 rupees. Okay. Suppose if an existing shareholder of Asian Paints Limited, if he wants to encash or if he wants to gain gain by selling his shares, so he can do so, and he can sell his shares at rupees 157, and again previously he would be getting uh, he has got rupees 8, so that makes the total worth or total value of his gains to rupees 165. So but again in the case of Berger Paints also, even or in spite of not getting dividend, the market price or market value of shares stood at rupees 165. That makes no difference in gains of shareholder of Asian Paints and Berger Paints Limited. So both will gain at the same rate or at the same value. So this is about the conclusion of this problem. Now let us move towards another problem. Probably this would be the last one. Okay, so there are two problems. We'll see. Problem is like this. Apply Modigliani-Miller hypothesis and determine the share prices of the following companies after the declaration of dividend. Company Britannia Industries, face value rupees 10, price before declaration of dividend is 1800, dividend per share is 14, cost of equity is 2.83, net profit in crores 126.60. Glasgow Smith Glasgow SmithKline, face value rupees 10, price before declaration of dividend 621, dividend per share 8, cost of equity 4.1, net profit 107.20 in crores. Heritage Foods, face value 10, price before declaration of dividend 177, dividend per share 3, cost of equity 5.5, and net profit 10.20. Nestle India, face value 10, price before declaration of dividend 1165, dividend per share 25, cost of equity 2.76, net profit 309.60. Ravalgon Sugar, face value 10, price before declaration of dividend 5,980, dividend per share 50, cost of equity 1.2, net profit 5 rupees. Sorry, 5 crores. So this is about the problem. Now here we have to calculate the market value of shares or market price of shares after declaring dividend. Formula, just we have to put all the necessary information to the formula. Now price before declaration of dividend, so 1800, 621, 177, 1165, 5980. So all these are to be taken as P zeros. Okay. Now cost of equity. So KE 2.83, 4.1, 5.5, 2.76, 1.2. So these are all cost of equity, KEs. Okay. And D, so that is dividend per share, would be 14, 8, 3, 25, and 50 for the respective companies. Okay. All the particulars or all the informations now we are having, right? Okay. Now just proceed with the solution part. Okay. For the Britannia Industries, see, you can observe here, I have explained what is P0, what is KE, and what is D. So everything I have explained and everything it is there in the table. Okay. For Britannia Industries, the market price would be 1836.94 after declaring dividend. So before it was 1800, and after the declaration of dividend, so it is 1836.94. Now price after dividend of Glasgow Smith. So before declaring dividend 621, and after declaration of dividend it is 638.46. Price after dividend of Heritage Food is 183, but before it was 177. Price after dividend of Nestle India, it is 1172.15. Before it was 1165. Then price after dividend of Revolgon Sugar is 6001.76. Before it was 5980. So this is about the solution. Okay. Now next part or next problem is the financial details of 5 automobiles companies, 2 and 3-wheeler manufacturers given below. Using model, calculate the impact of dividend declared on the share price. Okay. Now here Bajaj Auto is having a face value of rupees 10. Price at the beginning 2,972. Net profit is 701.50 crores. Dividend at 250%. Okay, cost of equity is 2.2. Hero Honda is having a face value of rupees 2 per share. Price at the beginning is 853. Net profit is given 745.80. Dividend 1000%. Okay, and cost of equity is 4%. Maharashtra Scooters face value is rupees 10. Beginning value P0 would be 458. Net profit is 6.20. Dividend at 25%. Cost of equity is 1.1. Majestic Auto face value rupees 10. Price at the beginning 68. Net profit 1.30 crores. Dividend 10% and cost of equity is 3.5%. TVS Motor Company face value is rupees 1. Price at the beginning 159 rupees. Net profit 135.80 crores. Dividend 130% and cost of equity is 3.4. Okay. Now here what we are supposed to calculate is first we are supposed to calculate is the dividend per share. See here, dividend per share is not straight away given, so they have given in percentages. Okay, dividend in percentages. Formula you know, P0 1 plus KE minus D1. Okay, now KE means cost of equity, it is given here in the last column. D1 is dividend. Okay, dividend given, but in percentages we have to calculate per share dividend. KE known, D1 known, P0 is also known. That is face value. Oh, sorry. Price at the beginning, not face value, price at the beginning. So this is P0. Okay. Now, first we have to calculate dividend per share. Bajaj Auto. Bajaj Auto face value is 10. On the face value, dividend will be rewarded. On 10 rupees, 250% means we'll be getting rupees 25 as dividend. So for the Bajaj Auto, D is 25 and all the information we have 2972 into 1.022 minus 25, that leads to 3012.38. Okay, as the market price. The next Hero Honda 1000% dividend means 2 rupees into 1000% means that leads to rupees 20. Now beginning price is given 853 into 1 plus 0.04, that is cost of equity, minus 20, that leads to rupees 867.12. Then Maharashtra Scooters at 25%. So 10 into 25% means rupees 2.50. Now the price after declaration of dividend is 458, that is price at the beginning, into 1 plus 0.011 minus 2.50, that leaves 2 rupees 460.53. Then Majestic Auto, the rate of dividend is 10% on the face value, that leaves 2 rupees 1. Price at the beginning 68 and cost of equity is 3.5%. That means 68 into 1 plus 0.3, 1 plus 0.035 minus 1, that leaves 2 rupees 69.38. Lastly, TVS Motor Company, the face value is rupee 1, percentage of dividend is 130%, that leads to rupee 1.30. Okay, Now, the profit price after declaration of dividend for TVS Motor is rupees 163.11. So this is about the solution under Modigliani and Miller model. From the next class onwards, we'll be starting up our last chapter, that is financial statement analysis or analysis of financial statements. I think this is sufficient for the today's session. Let's see you with the new chapter in the next session. Thank you.